Well, markets are pricing in a 100% chance that the Fed will cut rates in September, but whether it will be a 25 or 50 basis point cut has been up to some debate here. As of this morning, traders are leaning towards easing by 25 basis points. That is a huge change from 2 weeks ago when the odds were more in the 50 basis point camp. The economists and strategists we've talked to over the last few weeks have been quite mixed.
This just about guarantees you're going to get a 25 basis point cut.
The 50 needs to be the base case at this point.
If I were there, I'd be arguing for a 50 basis point cut.
The Fed's going to start cutting rate in September, but it might be only 25 basis points.
All right, so who's right? Joining us now with his take, we've got James Knightley. He is the chief international economist at ING. James, what camp are you in?
Yeah, I mean, this time last week, I was certainly in the 50 camp, but of course, following, as we say, you saw the better retail sales numbers, the stronger consumer confidence numbers. I just think the natural caution of the Fed may well creep in, and they may choose to kick us off with a 25 basis point cut, but leave the door open to possibly stepping up and doing more should the data warrant it.
What would warrant 50?
I think it is that jobs numbers. I mean, the two pillars of the Fed targets, you've got the inflation. Is that on the path to 2%? Well, the recent data flow suggests that we are tracking on that pathway. And the Fed has told us they don't want to wait until inflation actually hits 2% because they may have left it too late by that point. So they're starting to focus more on that second pillar of maximizing US employment. But of course, we know that the unemployment rate has risen from 3.4% at the bottom last year up to 4.3% today. So there is clear justification to cut rates. But if that unemployment rate starts moving higher and higher, and we say we end the year close to 5%, then if that is starting to factor into the Fed's thinking, then there is clearly an argument for them to go a little bit harder, a little bit more quickly.
James, is there a risk that the Fed is a little too cautious still? I mean, if they go 25 basis points and maybe the risk that could ultimately pose here to the economy?
There is. Monetary policy does, as we always know, operate with long and varied lags. And there is that chance that we do start to see some of the business surveys, which have been much weaker than the official activity numbers, start to be picked up and reflected more in that official data. And the Fed starts to have to think about playing catch up to where we are. So I certainly think there is that risk. So it'll be very interesting to see how Jerome Powell discusses that when he speaks on Friday.
All right, yeah, perhaps he's going to do some fly fishing after it, but before that, he's going to have to speak with us and speak to the public about what he's anticipating for the pathway for those rate cuts. What do you anticipate the tone that we hear from Fed Chair Jay Powell at Jackson Hole will be Friday?
Well, we've got to remember, the last time that they set out their numbers was in June, and there they were pretty upbeat on growth, about a half percentage point more forecasting faster growth than the consensus amongst the economists were. They were saying the unemployment rate was going to stay and hold at 4% through to the end of the year. Well, we're already up at 4.3%. They said that they were only going to cut rates once. Well, the market's now pricing nearly 100 basis points, nearly a full percentage point of cuts. So I think they will have to certainly move in terms of the commentary. So I think it will be one acknowledging that inflation has slowed perhaps a little bit more quickly than they'd been thinking, and that the jobs market may be slowing a little bit more rapidly than they had been believing would be the most likely case. So that, I think, will set out the case for a series of interest rate cuts as they move policy from what they may term restrictive territory, acting as a brake on economic activity, towards a more neutral level, where it's more evenly handed in terms of growth and controlling inflation.
James, I'm curious just your assessment on the consumer so far, because we have been getting so many conflicting signals when it comes to that stronger than expected retail sales print that we got last week. We're hearing from more and more retailers that are talking about the fact that consumers are either trading down or pulling back on their spending or doing both. Is the consumer maybe weaker than some of these headline numbers make it appear?
I think it's a really interesting question because we've got some parts of the US household sector which are doing fantastically well. The top 20%, they've got strong incomes. Inflation isn't really an issue for them. They've got job security. And of course, high interest rates benefit them. They may have locked in at low funding for their mortgage and can put their cash in money market rates and actually benefit from higher rates. Lower income households are much more in a bind. We are seeing more pressure rising because of auto loan delinquencies, credit card loan delinquencies. So there is this mismatch. The top 20% doing very, very well, going to keep spending. The lower incomes households, perhaps the lower 60%, really feeling some financial pain right now. And how that battle evolves between the two is going to determine how quickly the US economy slows. I do fear that if we do see a cooling jobs market, that anxiety amongst lower income households could increase and could act as more of a brake on the growth story.
All right, great insight there. James Knightley, we really appreciate you taking the time. ING's Chief International Economist. Thanks so much.